How much do you need to spend $100,000 a year in retirement? We're talking 100 grand after taxes. We're going to look at all the factors that could possibly impact how long your money lasts, if you can maintain your standard of living, and how secure you'll feel over time given these various factors. Hi, I'm Troy Sharpe, CEO of Oak Harvest Financial Group, certified financial planner professional, host of the Retirement Income Show, and certified tax specialist. So we did a video similar to this, and it's one of the most popular videos on the channel. Has over 250,000 views, but I wasn't a big fan of the video because it was fairly complex and it involved a lot of calculations, and I don't know what I was thinking, but I was trying to help you understand how to calculate your estimated spending level given inflation and time value of money and various other factors. So we're going to do this again, but we're going to do it in a way that's easy to understand, and we're going to look at all of those factors I talked about before, but we're going to do so in a financial planning software as opposed to on the whiteboard. First thing I want to focus on is when we talk about spending $100,000 a year, we have to understand how inflation impacts the purchasing power of that money over time. We have erosion, because as time goes on, our $100,000 buys less and less goods and services. So we have to calculate that into the picture. The best way to do it is to simply look at a chart to show you what that means over time. So this is a visual of what spending $100,000 looks like in retirement. So we see here, 2021, the goal is $100,000. Again, this is after tax spend. So for some of you, if all of your money is in these tax-infested retirement accounts, you'll have to pull more money out. If you have gains in your non-IRA account, you may have to sell some stock, realize some gain, pay some tax. Everyone's situation is different, but we're going to look at those situations as we go through the presentation today. So what we're looking at here in this example is a 63-year-old couple with $1.5 million saved for retirement. They want to retire immediately, 2021. And living a long, full retirement, we can visually see how much to keep up with inflation, how much they need to plan on spending, or how much you need to plan on spending over time to maintain the purchasing power of those dollars. So here we are in 10 years. We're looking at about a 2.5% inflation rate. So again, some of you have left comments before that inflation is going to be much higher, inflation is going to be the same. The point here is not to identify every single possible situation. It's just to help let you know and understand some of the concepts you need to be aware of when you're looking at your retirement. Of course, customizing a plan involves some of the various beliefs and factors that are pertinent to your particular situation. But the Federal Reserve has been trying for over 10 years to get general inflation in the economy over a certain threshold. They've had a very, very difficult time of doing so. COVID has impacted some of the inflation reports that we're seeing now, far more than anything that the Federal Reserve has been able to accomplish over the past 10 plus years. So we're looking at a 2.5% inflation here. 10 years in, we need 124 to maintain that same purchasing power. 20 years in, 159,000 to maintain that same purchasing power. And then as we get out here to 30 years in, we're up to $204,000 is the equivalent of $100,000 in today's goods and services. So now when we start to look at these factors and whether you have enough, can you retire, can you maintain that standard of living, answering those big questions, we first have to look at all of the various factors, and these are not all of them, but these are some of the big ones that impact how long your money will last and if you can maintain that standard of living. So how much do you have in IRA versus what we call non-qualified funds? So retirement accounts like your 401k, your 403b, your IRAs, we call those qualified funds. The way I used to remember it a long time ago was you qualify to pay taxes when you take that money out. It's a technical term. If all of your money is in qualified retirement accounts and you have to pay taxes every time you take that money out, you really don't have as much as you think you have because you have a partner in that account. Uncle Sam, he may be a minority partner, but he still has a right to a certain percentage of every single distribution you make. So the ideal balance heading into retirement is to have a good mix of retirement account dollars, non-IRA dollars, and then ideally Roth or tax-free dollars. What is your investment strategy? Investment strategy, when it pertains to how long our money will last, has two primary factors. One, the growth rate that we can expect to achieve over time. But in reality, growth is not, like when we do average rates of return calculations, growth is not 6%, 6%, 6%, 6%. The more risk we take, theoretically, we can expect higher returns. But we also should expect what's known as a higher standard deviation. And that just simply means you can expect wider fluctuations the more risk you take in the year-to-year returns. Typically, most successful people in retirement will have a more narrow expectation or variation of returns. That means a smaller standard deviation, and it typically leads to greater success over time. But the investment strategy, this plays a big role into it, because if we take too much risk, we could have bad timing and suffer losses in the beginning, which depletes our portfolio, which makes it more difficult to withdraw the income that we want to maintain our purchasing power. And of course, if we're too conservative, we don't have enough growth over time, we're simply not going to achieve our objectives. When you take Social Security, this is a big one. Do you have a pension or an annuity? So all three of these, Social Security, pensions, and annuities, are guaranteed lifetime income sources. Do you and your spouse both have a Social Security check? When does it make sense? When is the optimal time for each of you, either individually or together, to take your Social Security? And that decision needs to be made with respect to everything else. So if you're fortunate enough to have a pension, that is great. There is nothing more comfortable in retirement than knowing every single month a certain amount of income will be deposited into your bank account. No one's ever come to me at any point in my career and say, Troy, you know what? I'm really tired of the $7,000 a month being deposited into my bank. It just doesn't happen. So guaranteed income sources provide a very secure sense of confidence and comfort in retirement. So how this, we call it a floor of income, how this pertains to your situation can dictate, of course, how much you need to pull out, which then mitigates investment risk to an extent, because you don't have to take as much risk because you have such a strong floor of income. So very important here, the decision with Social Security, and if you have a pension or an annuity, is we're going to see distribution and tax strategy plays a very big role in this. And then what is your longevity? How long do you anticipate living? What is your life expectancy, your spouse's life expectancy? What is inflation over time? So are we going to experience higher inflation over the next 30 years than we have over the past 30? All of these things calculate into how long your money will last. Can you maintain your standard of living? This is not all of the factors, but these are some important ones and some of the ones we're going to look at today. Okay, so we're going to look at a hypothetical couple, Jason and Mary. They are both 63 years old, both retired. Jason has Social Security. Mary does not have a Social Security check, so she will take spousal benefits. I have Jason living to 92 and Mary living to 94. Now, we receive comments sometimes that, Troy, why are you not using the average life expectancies? And the truth of the matter is, it's prudent as a financial planner, as a retirement planner, to plan on, if anything, a little bit too long than a little bit too less. There's nothing worse than being 88 years old and not having enough money because your financial planner expected you to die at 85. So truth of the matter is, again, with life expectancies increasing, treatments for cancers, various diseases, we're able to treat things and cure things that just 4 or 5 years ago we weren't able to. So I'd much rather you plan on a longer life expectancy than a shorter life expectancy due to advances in science and technology and medicine that we should see over the next 20 to 30 years. So these are the parameters. Again, if you have something that would impact your longevity, this is something we can customize to your particular situation. Maybe one spouse is older than the other and one spouse is unhealthy, and the surviving spouse may have 10, 15, 20 years additional life expectancy over the other. All of these things are customizations that can be tailored to your particular situation. But here are the parameters. Now, we're starting out in this first analysis just looking at $100,000 a year. When the husband passes away, the living expenses drop to $80,000. I'm going to come back at the end of this video and do what we call a go-go plan and a slow-go plan. So in a go-go plan, we're spending more money in the early years of retirement. So in this case, it's going to be 63 through 75. At that point, we're going to reduce the spending by about 20%, because once we get into the slow-go years, we're simply not doing as much. We're probably not traveling. Our spending needs are just a little bit down. For the purposes of this example, this $100,000 includes healthcare expenses. We're looking at a 2.5% inflation rate over time, as previously said. So these are some of the basic parameters. Okay, money-wise, Jason has a 401k that he's going to roll over to an IRA, and inside that account is $1 million. In a taxable joint brokerage account, they have $500,000. So this is the mix between qualified dollars and non-qualified dollars. The 401k or IRA, qualified. The taxable brokerage account, non-qualified. So when we talk about distribution strategy and tax planning, one of the big impacting factors of how long your money will last, how much tax you pay throughout retirement, is how much do you take out of each of these buckets, and are you doing any Roth conversions? We're going to look at a very, very powerful tax analysis of this scenario in a different software when we get to that part of the video. But basic parameters, 1.5 million, 1 million in the 401k, 500,000 in the taxable brokerage account. No liabilities, net worth of 1.5 million. All these other possible inputs I've just ignored because I want to isolate. Do they have enough? Can they maintain their purchasing power? How long will that money last? And what are the probabilities? And look at various factors that can impact the answers to those questions. So we're going to go straight to the current scenario. So this is a 1,000 simulation experiment. What the differing factors are in the simulation, it's the investment returns. They might have +6, -2, +15, -12, +6, +7, +9, -13. That would be one simulation. We're going to look at 1,000 different simulations based on the parameters that we've input. 63 years old, both spouses. Taking Social Security, I have them initially deferring till 70. I'll explain why in a minute. And we're going to look at the Social Security analysis. 2.5% inflation, spending $100,000 a year, living to 94 and 92, run it 1,000 times. This is what we get, about 65% probability of success. Now, it's not a great number. We'd like to see that, of course, 85, 88, 92, 93. This is just a snapshot in time. Various decisions will be made between now and the many years to come that will impact this probability. But this is still 650 out of 1,000 successes. So if you think about it, it's not that bad. It's not ideal. We want this number to be higher. But still, out of 1,000 different simulations, 650 of them, we pass away with money. So what are some factors that can increase that 65% probability number? The first thing I want to look at is Social Security. Now, when we make Social Security decisions, we should not look at Social Security in a vacuum. We should look at it in the context of a complete retirement plan. That means, what is our tax strategy? What is our overall distribution strategy? Not just if I take Social Security here, it will give me this much and my spouse that much. It's how much will it give me overall, and how does that impact my taxes? And how does it impact my taxes not just today, but over time? And then how does that impact my distribution strategy? The distribution strategy, again, is how much are we taking from IRA and non-IRA, which ultimately is a function of the overall tax strategy. So in this example, we're going to look here. I have them taking it at 70. Now, the software, this is a different part of a different section of the software where, based on the risk that the clients are willing to take, it makes a recommended adjustment to the portfolio. That recommended adjustment does increase the probability of success from 65 up to 69, but it's not the point of this video. What I want to do is simply isolate taking at full retirement age versus age 70, and notice, one, it is $10,000 a year more income from Social Security if they defer until 70. Again, because you have an 8% simple interest increase per year every year you defer it beyond your full retirement age. So that gets up to $10,000 per year. Over the course of retirement, that's almost $100,000 in additional Social Security income. But the probabilities are equal as far as the success as it relates to them maintaining their purchasing power and spending $100,000 per year. So if the probabilities don't increase, why would we defer till 70? Why not just take it at full retirement age? The answer to that question is the tax strategy. So as we'll look at in a couple of minutes, by deferring the Social Security longer, we don't lose out on any probability of success. We actually get $10,000 more per year of total guaranteed lifetime income. But in addition to that, we're able to, because we don't have that income coming in, we're able to use that time to implement Roth Conversions, which is moving money from that tax-infested retirement account over to the tax-free Roth IRA. So this is the way I would like to go with this particular plan, because I do believe taxes are going to be higher in the future. So I want to get as much money into that tax-free Roth as possible, and one way to do that is to not have this extra income, because it leaves me more room before I get to that next tax bracket or maybe the one beyond that to do these Roth conversions. And it does have a good impact. So Social Security, I have them taking it at 70. Doesn't increase the probability, but it does open up opportunities on the tax planning side. With all that taken into consideration, I flip over. This is a different software. This one has a lot of the same features that we've just went through, but this one is primarily designed to look at the impact of distribution and tax strategy. So the only difference between these two scenarios, okay, in this one of the top ranked strategies for this particular couple, I set the Roth tax conversions to target the 12% tax bracket. And then from that point forward, after the conversions are done, to keep the taxes close to 0% as possible, which is completely doable, getting close to 0%. And for some of you under current law, and most likely to stay with the Biden tax changes, if your income is at a certain level, you can stay very close to 0% taxes throughout retirement, but there needs to be planning. Anyways, ending value with the tax and distribution strategy, about $558,000. No tax strategy, following what we call the conventional wisdom, which is defer your tax deferred accounts as long as possible until RMDs, live off the non-qualified. I have Social Security at full retirement age here versus the primary strategy there. We see ending value of 0, but here's the big one, $682,000 of estimated taxes paid versus $137,000 of estimated taxes paid. So it's called about a $500,000 tax savings over time, simply by implementing a strategic Roth conversion strategy. Everyone's strategy is different. This example, I just picked one. There's about 10 strategies that are very similar, staying connected to the plan, seeing how things progress over time, and making decisions, doing the analysis every single year. Ideally a couple of times a year, helps us to make better decisions. Sometimes we might want to be more aggressive. Sometimes we might not want to be more aggressive. Just depends on what's going on in the market, the economy, your life, etc. So this portfolio does last basically to life expectancy, but in the simulation, last year of life, they run out of money. The big one here is the $500,000 in potential tax savings. Big difference over time. All right, so as you can see, there's a big impact when it comes to our tax decision and distribution decisions during retirement. $500,000 of savings here. One of the most important things is to keep in mind this is just a snapshot in time. We want to be tracking our progress. This is what I call staying connected to the money by looking at this a couple of times a year and seeing our trends. Is our probability of success increasing? Is it staying the same, or is it decreasing? Staying connected and seeing the trend is what helps us make better decisions throughout retirement. So we have a link down below. If you'd like to have a conversation with one of our advisors, learn what it takes to work with us and have a plan like this put in place, learn more about our investment philosophy, strategy, how it all ties together, make sure to click that link down below. If you're just here for the videos, that's great. Hit the subscribe button, hit the thumbs up. If you don't like the video, hit the thumbs down. And of course, I always like to hear your comments down below. We're getting close to doing another one of those videos where I respond to the comments. So please engage with the channel. We do appreciate it. And I look forward to seeing you on the next video.